Hey everyone, welcome back to Corporate Decoder. Today we're diving into Morgan Stanley's annual report, and let me tell you, it's less banking boardroom and more roller coaster ride. We'll decode what all the numbers and legal jargon really mean, so stick around, you might just learn how to survive the next market dip. Alright, let's jump into the table of contents so you can see where we're headed. This report, like all big company reports, is long, but we'll stick to what you need to know without getting lost in the weeds. First up, their business. Morgan Stanley describes itself as a global financial firm right in the heart of New York that advises and originates, trades, manages, and distributes capital. Basically, they help governments, big companies, and individuals handle their money and investments. The key to their success, their employees. The company openly states our employees are our most important asset. They focus on a culture of rigor, humility, and partnership. A fancy way of saying they want smart, hardworking people who play nice. Of course, they're not the only fish in the financial sea. There's some serious competition out there from commercial banks, investment banks, digital investing platforms, and even tech companies getting into finance. Morgan Stanley needs to stay on its toes to attract clients, offer better technology, and keep prices competitive. Here's where it gets a little dense, but bear with me. Supervision and regulation is crucial. As a big financial player, Morgan Stanley is watched closely by the government and regulators in the US and around the world. They have to follow rules about what they can do with money, how much they need to keep in reserve, and how they manage risk. Because they own banks, they are a financial holding company and must abide by the Bank Holding Company Act. One such act includes the Volcker Rule, which basically stops banks from making risky bets with their own money. Speaking of money, capital requirements are non-negotiable. The Federal Reserve sets how much capital, essentially, the company's safety net Morgan Stanley must have. This ensures they can weather financial storms. These rules could limit their ability to pay dividends or buy back stock. It's not just about capital, it's about liquidity requirements too. They need to have enough readily available cash to cover potential outflows, even in a crisis. And here's a big one. The systemic risk regime means they have to conduct stress tests to see how they'd hold up in various disasters. If they are deemed a grave threat to U.S. financial stability, regulators may restrict their ability to do certain things or force them to sell off businesses. Because of this, the company needs to create resolution and recovery planning to outline how they'll handle financial distress. It's basically a break glass in case of emergency plan. They even have to submit a recovery plan to show how management would get the company back on its feet if things got tough. Moving on, there's cybersecurity. This section highlights the ever-present threat of hackers and data breaches. They discuss their cybersecurity legal, regulatory, and disclosure requirements. A single successful attack could cause massive losses and reputational damage. Now for the risk factors. This is where they list all the things that could go wrong, a bit like airing dirty laundry, but essential for investors. One that keeps popping up is legal, regulatory, and compliance risk. Lawsuits, investigations, new rules, failure to follow rules, and everything that comes with it. They also note the ever-present threat of cybersecurity attacks. Another thing on the list are changing compensation rules, noting that it could have an adverse effect on our ability to hire or retain the most qualified employees. Now we are at the management's discussion and analysis of financial condition and results of operations. Basically, this is where the company explains how they did in simple terms. The big headline, the firm reported net revenues of $61.8 billion and net income of $13.4 billion, reflecting strong results across our business segments. Strong performance overall with rising stock prices and investor activity to thank. They brag a little about their expense efficiency ratio of 71%, which is a calculation about how well the company made money relative to what it spent, which is a fancy way of saying they made more and spent less. Breaking it down by segment, institutional securities net revenues were up thanks to higher client activity and improved market conditions. Wealth management also did well with more people using their services and bigger accounts. Investment management was helped by higher average assets under management. But they don't ignore the risks. Significant changes to interest rates could adversely affect our results of operations. Higher rates could mean lower net interest income and changes in investor preferences. Now we are at the good stuff, the details about risk. We learn about credit risk, market risk, and other risk factors, and we see they say they need a failure, breach, or other disruption of our operations or security systems or those of our third parties. But they believe their business contingency and security response plans will mitigate all potential risks to us. Remember, it's crucial to read the forward-looking statements section. It's a disclaimer. Basically, they are trying to temper expectations that the future may be different than what is reported or expected. And lastly, before my thoughts, there is a section that provides more detail on our human capital programs and initiatives. See Human Capital in our 2023 ESG report found on our website. Now for my take. Morgan Stanley had a solid year, strong revenue growth and net income. They seem to be executing their strategy well, but I would be aware of a few things. The big one is legal and regulatory risk. Fines or restrictions could throw a wrench into their plans. They are also exposed to the whims of the market. If stock prices tank or interest rates go crazy, their profits could suffer. A changing world with cybersecurity threats, trade wars, and climate change could all present headwinds. However, they're a smart company. Management seems proactive, and they're building a diverse business that can weather different economic climates. Based on an analysis of the financials and the forward-looking statements, a long-term analysis based on future growth and projected free cash flow, it seems to me that Morgan Stanley shares could be worth between $90 and $110. They're currently priced a little high, but I'm optimistic in the long term. Their ability to retain and attract qualified employees is critical to the success of our business, and the failure to do so may materially adversely affect our performance. So in conclusion, I'm leaning bullish on Morgan Stanley. There are clearly risks, but they have a solid foundation and a plan for the future. That's all for this week's Corporate Decoder. I hope I've helped make this complex report a little easier to understand. If so, be sure to subscribe to our channel for more financial breakdowns. You can also find the link to the SEX website if you want to dive into the full 10K report for yourself. Thanks for watching.